Vivek Paul is the head of portfolio research and the UK chief investment strategist at BlackRock Investment Institute. Thanks so much for being with us.
Thanks for having me on.
All right, so I know that you have noted that the Bank of England was the earliest of its peers to begin the process of monetary policy normalization. It's now further along this tightening path. Do you think, keeping this in mind, that the U.S. Federal Reserve, that it kept rates too low for too long, so it made a mistake?
I think there are a bunch of differences and similarities between the two situations. And I guess the similarity, is as per the sort of previous correspondence you had, we're in an environment where supply-led sort of issues are dominating the inflation regime globally. Now, the issue, and the difference is where each of those two sort of central banks are in their journey towards ultimate tightening. And there are differences here because, you rightly pointed out there that the UK was earlier to sort of get going, but the other point would be that the UK's natural sort of neutral rate of interest is also probably lower than the US's. So from here, you could almost kind of see in some ways that the Bank of England is almost a little bit of a case study for other central banks as they get further on in their sort of tightening journey. We are of the view here that actually, this is an environment where you're going to see material rate rises for a period of time, particularly in the US, whereas the Bank of England might be a little bit more of the camp that they're getting to that stage where they're explicitly weighing up that sort of dichotomy that they're facing here, which is, do they prioritize getting inflation under control, or do they worry about those growth impacts? And what marks out the Bank of England as a bit different to the Federal Reserve is more explicit acknowledgement of that trade-off, more explicit acknowledgement of the fact that there are sort of real recessionary pressures baked into their own forecasts. And as your previous correspondents were saying, that the growth prospects in the UK in the near term look quite weak.
And you use the R word there, and I know that you say that the Fed seems dead set on raising rates this year to levels that would clearly slow the economy. I'm curious to hear what kind of recession you see. Is this one that would be fully entrenched or one that would be more shallow?
Well, I think with using that dreaded R word, I think it is different, in terms of the likelihoods going across the world. I think the proximity, that Europe and the UK has to the crisis that is unfolding in the Ukraine is greater. That means the impact on our energy prices indirectly and also, more broadly on growth is more pronounced and felt here. So the likelihoods clearly, would be greater in Europe than they would be in the US. I think in the US, the big risk, is one of your previous correspondents talking about that lagged effect between enacting policy and the impact that it might have on growth. And the real fear here, is that the Federal Reserve might go materially above neutral. That's what they're indicating to markets, sort of mid-digit, sort of 3 and 3.5 type range, where we see neutral for them more like 2.5. So with that in mind, if they go materially above neutral, that's when you're likely to see potentially that slowdown occurring perhaps in the first half of next year. And to be clear, when we're not talking about, automatically that being a repeat of the global financial crisis or something like that. All recessions are different, but still the odds of a downturn are materially greater than they perhaps were.
The Fed obviously is in the middle of a very delicate dance trying to lower inflation while raising rates and possibly causing a recession. Do you think that the Fed is misreading something here about inflation that is looking to resolve the problem?
I think what I would say is, clearly central banks across the world have come to the fair and right conclusion that it is right to normalize policy. We don't need the same level of extraordinary stimulus in an economy, broadly speaking, that is restarting in the West than we did, during the pandemic. So the idea of normalizing makes a lot of sense. I guess it's more that explicit acknowledgement of the supply-led nature of it and the idea that in such an environment, there's only so much central banks can do, or put another way, they have to impact growth much more materially to see the same impact on inflation than would have been in the case had this been demand-led. And I think that's the area, kind of being explicit about that trade-off, about the sort of the difficult choices that they're facing. I think that's the element where other central banks perhaps have been a little bit clearer, and therefore there's less likelihood of an about turn in terms of policy in other regions.
Vivek Paul, thanks so much for your perspective, and thanks for coming on the show today.